Some client portfolios may have performed differently than certain market indexes or popular areas of the market recently. And I know that does not feel good, and I want to talk about it directly. The market has had a strong run in certain areas. Some funds, sectors, and parts of technology have gone up a lot. And when that happens, it is natural to look at your own portfolio and wonder, why are we not chasing more of that? And that is a fair question, and you deserve a thoughtful answer. I also want you to know we are not dismissing the recent lag. We are reviewing performance relative to each portfolio's objectives, risk profile, and appropriate benchmarks. And we are asking whether any lag is coming from intentional positioning or from something in the portfolio that may need to be adjusted. Short-term lag can occur as part of a disciplined strategy, but that does not mean that we completely ignore it. And your financial goals matter, and we are paying attention because this is not play money. This is your money. Money you worked for, money you saved, money that came from years and years of decisions, sacrifices, risks, and patience. So when we build a portfolio, we are not trying to win a 6-month popularity contest by any means. We are seeking to build something that aligns with your goals, risk tolerance, time horizon, and liquidity needs, and the role the money plays in your life. That requires discipline. And sometimes discipline can feel uncomfortable for a while. And right now, parts of the market are getting a lot of attention. Some areas have performed very well. Some areas have attracted significant investor enthusiasm. And when you're not fully concentrated in those certain areas, it can feel like you are maybe missing something. And I understand that. But my job is not to chase what is popular simply because it's popular. My job is to ask quieter question on your behalf. What do you actually own? What is it worth? How durable does the business appear to be? And how much risk are we taking? And how might different market conditions affect the portfolio? Attention and value are not always the same thing. And history is full of examples where the most popular areas of the market looked obvious at the time. There have been many periods when a company, sector, or theme became so popular that investors stopped asking what they were even paying for. And sometimes the company was real. Sometimes the product mattered. Sometimes the story was even directionally correct. But the price still became difficult to justify. And that is one of the hardest lessons in investing. A good company can still be a disappointing investment if the price paid is too high. And an unpopular company may become more interesting if the price becomes more reasonable relative to its fundamentals. And that is why we care so much about price, because price matters, because risk matters, because client money deserves discipline. So yes, many portfolios have not kept up with some of the strongest performing parts the market has recently seen. And part of that is because we are not making an entire portfolio one large bet on what has already gone up the most. And part of that is because we have been building positions in businesses that are, based on our research, we believe may be trading at prices that do not fully reflect their long-term value. And that can feel uncomfortable, especially now. But we are not buying something simply because it is down. A stock being down does not automatically make it cheap. A stock being popular does not automatically make it safe. And we are attempting to separate short-term market volatility from actual long-term business impairment. A stock price may recover. A business that is permanently impaired may not. And our job is to evaluate that difference carefully before allocating client capital into those areas. And I want to be clear about something else. We are not married to any investment. If the facts change, we will reassess. If a business thesis weakens, we will also review it. If the risk no longer appears appropriate for your plan, we will consider making adjustments, because long-term investing does not mean stubborn investing. It means being patient when the facts support patience and being willing to change when the facts actually change. And that is why portfolios like this are built with balance. And part of the portfolio is intended to provide participation, and we want to exposure to businesses and themes that may benefit from long-term innovation and economic growth as well. But part of the portfolio is also intended to help manage risk. And depending on your individual allocation, cash and short-term treasury bills may play a role in that. And we also own a mix of businesses that may behave differently in different markets depending on what's going on. And the goal is not to be all offense, and it's not to be all defense either. The goal is to remain disciplined through different environments. And if markets continue higher, the portfolio is intended to maintain meaningful exposure to risk assets. And if markets decline, cash, short-term treasury bills, and diversification may help manage that volatility, although they don't eliminate or provide any guarantees against losses. And if investments we have researched become available at prices we believe are even more reasonable, liquidity may give us flexibility to then act. And that is not an indecision, that is discipline. And there may be days when the broad market is down or when a technology-heavy index is under pressure, and portfolios like this may behave differently. And that could be a result of intentional portfolio instruction. And that may happen because the portfolio is not intended to be a copy of just one index, one sector, or one popular theme. One day does not prove a strategy right or wrong. But days like that can be useful reminders, and they show that a portfolio can have more than one way to behave. And it may participate when markets rise, though not always at the same speed as the most aggressive parts of the market. And it may behave differently when areas that have led the market begin to get pressure. And that is the part of the design. We are not attempting to build a portfolio that only works if the same handful of stocks keep going up. We are wanting to build a portfolio that can move through different environments with discipline. And cash can be frustrating in a rising market, and I understand that. But when cash is part of the overall allocation, it has a job. Cash gives a portfolio that flexibility, it gives us patience, and it may reduce the need to sell other investments at the wrong time. And it may allow us to act better if opportunities appear. And there are two mistakes I am hoping to avoid with your funds. The first mistake is being too afraid. If we are too afraid, we may miss the potential benefits of compounding, innovation, and potential opportunities for a long-term outlook on your investments. The second mistake is being too aggressive. If we are too aggressive, we may chase what already went up, ignore valuations, underestimate risk, and convince ourselves that a great story means any price is acceptable. Both mistakes can hurt long-term outcomes. So we are trying to live somewhere in the middle. Not scared, not reckless, but disciplined. And enough participation to benefit if long-term growth continues, and enough balance to help manage that risk, and giving us enough flexibility to act when the facts support it. So what does that mean for you? It means there may be periods where a portfolio lags. That is part of disciplined investing. A portfolio built around your long-term future will not win every month, every quarter, or even every year. If one narrow part of the market goes straight up, a balanced portfolio can look boring for a period of time, but boring is not always bad. Sometimes boring is what helps support discipline, and sometimes boring is what gives you that flexibility. And sometimes when the markets rotate away from the most crowded areas, that balance becomes more noticeable. That does not mean we will avoid every single day the market's down. We will not. It does not mean we will outperform every time the market starts to struggle. We will not. And there is no guarantee that current positioning will outperform over any specific period. Periods of underperformance may continue, but the portfolio is intentionally built with different sources of potential return, different types of businesses, and different ways to help manage your risk. So here's the simplest way to say it. We are not trying to be different just to be different. We are looking to manage client money thoughtfully, and we are seeking to own durable businesses at sensible prices. And we are not trying to overpay for what is popular. We are trying to evaluate market volatility carefully and act only when business quality, valuation, and risk profile appear to support it. And the market will always have areas that look obvious in hindsight, and there will always be something we wish we had owned more of 6 months ago. But we are not building portfolios for 6 months ago. We are building them for the years ahead, for retirement, for family, and for the future. for the life this money is supposed to support. That is the work. Not chasing noise, not avoiding risk completely, not pretending we have some sort of crystal ball, just weighing what we own, managing what we can control, and respecting that we cannot control, and staying disciplined for the long haul. And as always, investing involves risk, including the possible loss of investment principal. Past performance does not guarantee future results, and no strategy can assure a profit or protect against loss in declining markets. Fees and expenses will affect the investment returns, and references to market indexes are for comparison and context only. Indexes are unmanaged and cannot be invested in directly. And this video is for informational and educational purposes only and should not be considered individual investment advice or a recommendation to buy or sell any specific security. Any references to market conditions, portfolio positioning, or investment process are general in nature and may not apply to every client account. The right portfolio is different for each client, and your allocation should reflect your personal financial situation, goals, time horizon, liquidity, and risk tolerance. If you have any questions about your personal situation, please reach out to me directly so we can talk through it together. And if you made it this far in the video, I just want to let you know that I'm on it, and I promise to continue doing my best, and I'll see you next time. Bye.